Hi, everybody. Good afternoon. Hope you're all well. We'll just give a few minutes to let a few more people join this webinar, but welcome. Okay, so I'll get kick started. It is 3:01. So hello and welcome to this special event that we at Buzzercott are putting on after the budget. The title of it is the VAT Tax and Financial Update for Housing Associations. This is a webinar. I hope you'll know you're here at least. I am John Butler. I'm an assistant manager at Buzzercott. I think quite a few of you will know my time at the National Housing Federation, where I was finance policy leader for 14 years. But I've joined Buzzercott since May and working in their charity team and working on auditing housing associations and a few other bodies. Also joining me at this webinar are two of our tax and VAT partner and tax partner. So there's Socrates, who's our VAT partner in the charity department, and Luke Savvas, who's our sort of corporate tax partner, also in the charity department. What we're going to be looking at today really is the consequences of the budget, the impact for housing associations and sort of beyond. That's going to be me. The sort of tax update is going to be Luke. I'm also going to call Luke into my slides for a bit, a small part of my slides, just to give some relevant updates to some of the tax changes. And then we're going to look at a VAT update with Soc as well. Just to do a bit of sort of virtual housekeeping. So first one is while your cameras can be switched on, your microphones will be automatically muted during the presentation portion of the event. This to stop any feedback noise, etc. When it is time for questions, however, that sort of microphone switch off will be lifted, and you'll be able to unmute and engage in the conversation and ask questions. Also, if you need to ask any questions at any time, including when any of us are talking, you can also ask via the Q&A part of this app. So if you go to the top sort of banner, you will see the Q&A button. If you just press there, on your right hand side should open up the chat functionality, and then you can just post questions on there during the event. The other point to make, that's kind of the final point about this, is that the slides and a copy of this recording will be shared with you after the event, so you don't need to feel like you need to write anything down. It'll all be sent to you shortly afterwards. So now I'm going to move on to the first section, which is me to talk about really the budget and sort of beyond. So I'm sure a lot of you have seen what's happened with the budget over since 2 weeks ago, but I think it's worth looking back really, and I will in these slides look back to really when Labour came to office, because they've been pretty busy. I mean, the first thing to say with the Labour Party and this government, they've been in post 132 days, and yes, that's right, we've still got a housing minister who started at the job when they came into office. That almost a modern day record, 132 days for the housing minister. So that's really positive news. They've also been very busy and carrying out quite a lot of work that has implications for the sector. If I go to can we go to my next slide? And so what I'm going to talk about in this today are some of these areas, particularly the first one, which came shortly in the first few weeks after they came into office, is planning reforms. A couple of other early developments I'm going to touch on, namely the Grenfell report, which was obviously nothing to do with them, but has come out during the administration. Also, an announcement about potential housing strategy, the budget, the particular specific sectoral announcements, rents, which is kind of one of the biggest things coming out of the budget, supported housing, some of the implications from some of the other changes which were less sectoral specific, I will touch upon there. And a letter a couple of days ago or yesterday went from Homeless Link to the government on some of the impact of this, and I'll talk about that and maybe some of the work you can do as your own bodies, and then a sort of longer term view of what's coming up. So if we can go to my next slide, please. So the planning reforms. So I suppose the government, the Labour Party, long mooted planning as being one of the ways that they perceived, firstly, that they could look to improve sort of the build of properties and really get more infrastructure built, and also then to, by extension, by then pushing that and to increase and improve the economic growth of this country. and that they have brought in some significant changes, potential changes to the planning system. The first one of these, and the most relevant to this, one of the most relevant ones, at least to this sector, is the removal of the infrastructure levy. When I was at the NHF, the previous government first mooted this a couple of 2 or 3 years ago when Michael Gove was the Secretary of State. There was significant concern that, I was first mentioning that it would remove Section 106. Those of you on the call are probably aware, but Section 106 provides for about half of all affordable housing developments by housing associations, and that infrastructure levy, it was very hard to foresee how that infrastructure levy, when it would be brought in, whether it would bring about the same level of affordable housing developments. So I think a lot of people, including the NHF, are very pleased that that infrastructure levy has now fallen away and it will no longer be brought in. The new government also have been looking at grey belt usage. So this is parts of the green belt that have been previously used as sort of disused car parks or other maybe petrol stations and the like. So that is, they're identifying those sites where they think there can be potentially those that more land can be brought forward for new development. And then another interesting area from these planning reforms is new towns. So they've brought together a new towns task force. I think that's 8 to 10 people from kind of inside and outside the sector. Kate Henderson, Chief Executive of the NHF, kind of from previous experiences on that task force. A couple of interesting points. So that task force, they need to report by July next year. They are looking at sites where they can build at least 10,000 homes, where the ambition is that 40% of those should be affordable, and that their report and the findings from this task force will report directly to the Deputy Prime Minister. So it's quite a significant movement. Be interesting to see what happens to that. Also, in lieu of the fact that the government has trailed and was in their manifesto and continues to have this ambition to build 1.5 million homes over this Parliament. It's probably the case that with these planning reforms, they have got to, obviously they need to be able to roll these out, these planning reforms, but they have identified the ways to identify the sites to enable these 1.5 million homes to be built. They now need to play at the other factors. Chiefly among those is money. Obviously, there are other factors in play, but money is one of the big ones. And I'll talk more about that shortly further on in my slide, about particularly looking at the long term and potentially the upcoming spending review in the spring. So now to my next slide, please. So other early developments, 2 things I just want to touch on. The first of these is the Grenfell report, the final Grenfell report that came out on the 4th of September. It started in 2017, shortly after the tragedy. The report is significant. It covers a huge amount of ground. It's definitely worth having a read of this, and certainly the areas that touch on you as an organisation. My understanding is that the Federation is considering putting some kind of document out, so maybe look out for that. There's also been announced by the Deputy Prime Minister, by Angela Rayner, that at some point next year, I think around the spending review, they will look at a housing strategy. Now, what will be is something that many in the sector have been calling about for a long time. But what's going to be interesting to see is how that housing strategy then interacts with their target of 1.5 million homes over this target, and whether it will touch on all the different facets and forms of the housing crisis as we all know it, and just the extent to which it will cover. Hopefully there will be the opportunity for lots of organizations and individuals to feed into this, but that's going to be interesting to see where and how ambitious, I guess, that housing strategy is. So to my next slide, please. Now onto the budget itself. So these are kind of sectoral specific announcements that really have an impact on housing associations. The first one of these, I guess, is the 500 million extra for the affordable homes program. This will certainly help to move some of the sites that have been bunged up over the last year or two forwards. So it should help to create a sort of short-term boost to housing developments. I think a lot of people are seeing this as a kind of down payment on what should come in the spending review in the spring, but I'll again talk more about that in a second. There's also been announced a question mark, but an additional maybe 1 billion for the building safety fund. That is some of it. It's yet to be foreseen how much that is new, how much that is kind of recycled, but almost as importantly, or more importantly, certainly for housing associations, is that they will be consulting on or considering or figuring out how they can make this a much fairer access for housing associations, because at present, for housing associations to access the building safety fund, they need to demonstrate that they would not be financially viable if they bore these costs, which no housing association would sign up to because the lenders and other stakeholders. So the building safety fund has not really been touched by most housing associations, albeit the fact that building safety, for most large housing associations I spoke to and other housing associations actually through my time last few years at the Fed, it was certainly the case that building safety costs were the significant barrier really to increasing developments, and also leading to many calling into question and pausing their affordable housing developments. It's also worth stating about the warm homes plan. So they've announced 3.4 billion over 3 years for the warm homes plan. This, albeit over 3 years, is still kind of the first stage of what is probably more to come in the spring statement. And it's also worth pointing out that the third wave of what was called the Social Housing Decarbonisation Fund, the SHDF, is now called the Social Housing Fund. That wave 3 applications for that wave close on the 25th of November. So if your organisation has got their ducks in a row to respond to that, just make sure you are aware of that deadline, which I'm sure you are, but still a few weeks to go on that. So see if you can get some money in. And then also in this budget was an extra 1.3 billion for local authorities, much needed for local authorities. However, firstly 600 million for social care, and then 230 million to tackle homelessness and rough sleeping. We'll see how that interacts with what I'm going to talk about in a couple of slides, however. So my next slide, please. So rents. The government have launched a consultation on the social housing rent formula. They are sort of assuming in that consultation that there will be a 5-year settlement, albeit the sector has called for a long time for a much longer term look. They do question whether there could be a 5, 7 or 10-year deal, though. They also talk about a rolling one where every year it rolls on for another 5 years, another 5 years, another 5 years after that. From a housing association perspective, I guess the feedback would be as long term as possible, and also that index link, that CPI +1, being hugely important. Obviously, with when you're feeding back on this, and I would strongly recommend housing associations to feed back on this consultation, albeit I expect the Federation will be as well. But I think individual bodies should certainly make that case. But also thinking about the extent to which the affordability in your own tenants and providing that feedback as well into that consultation could be really useful. The consultation also confirms Decent Homes 2 in 2025, so next year. I'll talk a bit more about that in a second. There is no mention about convergence. So convergence, for those who don't know, up until 2015, housing associations where they were applying the social housing rent formula, where those rents were above or below that formula, they could uplift or decrease those rents by plus or minus £2 every week. That was the old measure. We thought in the sector that the government was having conversations, was understanding the impact of convergence and no convergence, and they were considering it. But it's absolutely silent on convergence, which is not very good news for the sector. And trying to again go back to that point, you would think the government has an interest to get the financial capacity of the sector back up if they really want to hit that 1.5 million homes target. In this consultation document, there is also a question about what other measures would respondents like to see that the government could do to support the financial capacity of the sector. In essence, that's the question. I think it is worth, again, I'll go back to my point about all housing associations responding on those, on whatever those measures could be. I think it's, if each individual association could really set out what they perceive as being those things that could be done by the government, particularly in relation to money, the building safety element, decarbonisation, all those kind of things. But certainly making the case there from your own individual organisational perspectives, and then responding by the 23rd of December. Important. So I would recommend everybody responding on that. Next slide, please. So supported housing. I think a lot of you on the call will be aware of the current financial environment of supported housing providers, often at very low margins, often running at losses, a lot of those schemes, so much so that the extent to which 1/3 of all schemes are in the last year or so have been mooted for closure because of this financial environment. A lot of those contracts are with local authorities, and obviously the financial environment for local authorities is incredibly problematic as well. And then this budget has brought in some changes, and I'm now going to hand over to Luke, who's going to run through what those changes are kind of across the sector. Luke.
Thanks, John. Thanks very much. Yeah, I'm going to touch a bit further in a minute my slides as well on this, some of the budget changes. But the one change that directly affects all organisations, so whether you're a commercial organisation or have charity status, as most housing associations we work with do, is the employment taxes and national insurance contributions. So the employer's rate, as there was sort of some hints that this would go up, has gone up to 15%, so 1.2% increase. You might say big deal, but when you look at your wage bills for a lot of organisations, that adds up to quite a lot of money. But the impact that a lot of people haven't really necessarily or didn't straight away take into account was the level at which employers and I comes in. So that was 9,000. That's reducing to 5,000 from April. So that's quite a big jump, and that's actually going to have as much impact for especially employers with a lot of people on low salaries. The other thing that's also going to affect the sector, the not-for-profit sector in general, but potentially the housing association sector, is the national minimum wage, or the national living wage increase by 6.7%. That actually to 12.2, I think it's going to 12.21 for next year. But that's going to have a bit of an impact, because we know there are a lot of people who, let's say, in the sector are maybe they're retired people, consultants, people who want to do a sort of a job and help, particularly with things the sector such as social housing, and may not be asking for much. And it's sort of like borders on whether the volunteers are paid, but happy to accept a minimum wage. So that could be something that affects. But there's also a lot of people that on the manual labour side that might be getting minimum wage. And so that's going to have a big increase to employers' wage bills. And I've had a lot of clients asking us about that, particularly industries such as housing and care as well, as the impact that will have. I'll talk a little bit more about some of those measures that don't as directly affect the sector as this, but I'll hand over to John to carry on talking about supported housing. Thanks, John.
Great, thanks a lot, Luke. Yeah, so I mean, as Luke has set out, those measures. I mean, I think as everyone is aware on this call, that those in the supported housing sector, often their employees are on national sort of living wage, and those costs going up by that significant margin, plus those other changes, will lead to some serious problems. I think the letter from Homeless Link to the government, which is in Inside Housing today, talked about a 50 to 60 million gap from sort of April next year when that comes in. I talked about the current financial environment for the sector. So I think it's going to be hard to see really either a lot of supported housing providers not in some significant having some significant problems with this, or the government stepping in. The government has already said that they will provide a rebate to the public sector organisations affected by this, obviously because they're in the public sector, but the extent to which the impact of this could be really felt is quite significant. So I also go back to that point from my previous slide about the rent consultation and that other measures question. If you are in supported housing, if your bodies have any supported housing, it is worth, I think, pointing out to the government again and again. There is that letter that's gone from Homeless Link. I think it's with 110 organisations signed up, but the more the government hears about this, the more they can only be aware of it. And so I think if you can provide that other measures and maybe just ask for that rebate as a sort of bare minimum to keep this sector afloat. So that is supported housing. Next slide, please, to my last slide. I think, yeah, this is my last slide. So just looking at some of the longer term things coming out. So the spending review is going to be in the spring of next year. That's been much mooted. I think the most interesting prospect of that from the sort of housing association perspective is this government's ambition to build 1.5 million homes. That sort of 500 million for the affordable homes programme being seen as a sort of down payment but also Rachel Reeves before this budget talking about changing the fiscal rules to enable a greater increase in infrastructure spending. The extent to which that infrastructure spending it then falls on the housing associations in lieu of the 1.5 million homes, but also the financial environment, the financial state of the sector is something that I'm sure will be many conversations within and outside of government over coming months leading up to spending review. So that could be a very interesting spending review indeed. Decent Homes 2, as I say, that should be coming out at some point next year. I think the greater kind of impact of Decent Homes 2 now will probably be on private rented landlords. That target of EPCC by 2030, which has been in most housing associations business plans for many years, is now going to be coming into sharp focus for the private rented sector. And so that will be quite significant. I think certainly when I was at the NHF, there were concerns from the previous government's version of Decent Homes 2 that there were significant cost elements. But after feedback from many housing associations, I think those have gone away probably. But be interesting to see what comes out of Decent Homes 2 next year. And then finally, sort of my final point on my slides is looking at a sort of new PFI type model. So we attended the Community Housing Summit, the NHF and CIH Community Housing Summit 2 months ago in September, and both sort of at the conference, at the plenaries themselves, and sort of inside and outside of those, there were various conversations about the Labour Party considering sort of new public-private partnerships, like a similar sort of thing to the PFI, but a sort of much more modernised version of the old PFI system. And then also an article in the FT this weekend about Rachel Reeves pushing more or local government pension schemes into collaboration, into mergers to create kind of super funds and pushing those super funds to invest in the UK, particularly in UK infrastructure. And what better place than for those local government pension schemes to invest in bodies that then lead to more housing being built in their areas, where that be in partnership with a housing association or potential and partnerships with housing associations, or potentially even looking at potentially where they could formulate for-profit registered providers with other funds and look to develop. There is various data out there at the moment which is showing that in the next 5 years, for-profit registered providers are likely to develop more affordable housing units than housing associations. Obviously, that depends on what happens in spending review and other factors, but certainly at the moment that is a likely outcome. So there's going to be lots of interesting stuff, I think, happening in that sphere over the next few years. But that's it for me. That's just what I wanted to say. So now I'm going to ask for any questions on my slides. We're going to do a few questions now, and then also some questions in the kind of sweep up at the end. But does anybody have any sort of immediate questions for me now? Don't think there's anything. Yeah, Richard Stevens. Oh, you're on mute, Richard. I think you probably need to unmute yourself. Yeah,
thank you. Yeah, you mentioned the possibility of rebates to sort of public sector organisations. Where does that stop? So if you have an ALMO or housing companies that sit below the local councils, do you think they might be eligible for rebates on this national insurance?
I haven't seen the detail behind that, but I think it's worth a question probably to the LGA to understand what that, because it is local authorities largely that have those sort of bodies that are part local authority, part sort of private or not for profit. So it's worth understanding. So hopefully the LGA will have more detail on that, but I would assume ALMOs would probably fall under that public banner from what my understanding of it, but worth checking with an organisation like the LGA, I think, on that. Great, thanks for that, Richard. Any other questions for the moment? No, cool. Okay, I'm going to hand over to Luke, who's now going to do a run through of some of the tax changes coming out of the budget.
Hello, right, thank you. Just thanks very much, John. Just getting my slides all sorted, but let's bear with us a moment. Anyway, probably just my screen that the slides aren't showing at the moment. So if everyone else can see the slides, I'll carry on from my notes.
Luke, sorry, one second, Luke. Sorry. Let me just get them back up for everyone. I'm not sure what happened, but there we go.
Lovely. Thanks, Rebecca. I thought it was just me being the Luddite in the room, but there we go. But luckily, I know a little bit more about tax than I do about tech. But thanks everyone for obviously signing up and listening to this. I'm not going to run through all of the sort of tax exemptions and things, which I did, I think, this time last year. Happy to talk to people separately about that, either after, or please do contact me later to talk about that. I could go on for ages, as my colleagues and other clients know. But it's really to talk about some of the things that have changed, mainly the budget, but some other things to sort of watch the space on. So if we turn to my next slide. Let me see, there's a fair bit on these slides, mostly as a takeaway, so I'm not going to go through everything in great detail, but the sort of highlights from the budget, well, it was quite controversial, as many people know. 2 weeks later, lots of people still talking, lots of chat about this, mixed feelings, lots of good things, lots of things to be concerned about, such as the wage bill that we mentioned earlier. As I said, the housing sector doesn't escape that. So they're there on the slides. The housing associations or sector, most housing associations do have a charitable structure, or most what we advise, or CBSs, or both, and both have tax exemptions or concessions available for them. So a lot of things aren't subject to direct tax. So you think that puts them out of a job, but there's so many pitfalls and conditions. And again, I'm not going to go through all of those, but some of those changes. But that means that there's quite a lot in the budget that doesn't directly impact you as housing associations, but can have an indirect change, and it's good to know. So moving on to the capital gains tax, for instance, there's a charity exemption. There's also a CBS exemption for selling to your beneficiaries, etc., and on property. But at the end of the day, it still affects everybody else. So it obviously affects individuals who buy and sell, and the rate has stayed, or the higher rate, 28% for residential sales investments. If it's your part of your principal private residence, then there's an exemption. But it would obviously, the budget is aimed at sort of detracting investment from sort of private individual landlords, and very much so. That's been the message even before this current government, and that hasn't actually detracted from that. The one change is the actual mainstream rate of capital gains tax that's gone, the higher rate, from 20% to 24%. May not seem like a big deal. Were we expecting more? Some people talked about it being 30%. I think possibly will go up in stages and maybe 30%. But what does that mean? That means that some people aren't necessarily going to be getting rid of a lot of their assets. So that could mean that they're actually holding on to things. And the people that you'll probably be more concerned about is some of the corporate investors and developers in land. That we've had a change going back from last year, which basically meant the corporation tax rate changed from 19% to a sort of staged upper level of 25%. So most of the big companies that you know of and deal with on the sort of building development side, and builders, building companies will be paying that 25% corporation tax now. So what am I hearing? How does that influence sales of lands? Well, I don't know. John probably, or others might want to comment on this, but I'm hearing about a lot of land banking for some of the big developers. So that could have an indirect consequence on the sector, as some of the big people like Taylor Wimpey, I'm hearing, are holding on to properties at the moment, because developments, there's obviously development costs, but also if they are making potential large profits or gains, then the corporates, they'll be taxed at 25%. So just something to bear in mind, indirect consequence. If we go on to the next slide, please. Stamp duty land tax. Again, charities have an exemption from that, but it will affect others. First-time buyers, not affected, thankfully, so at the lower rates. But second homes, so possibly you might say hooray for the sector as well on that one. Again, attacking the sort of the landlords, individual landlords on that side. And there's an increase in that rate, the extra SDLT, the additional one if it's a second home or additional property from that 3% surcharge on top to 5% from the budget. So yeah, as I've said in the notes there, it's really looking to sort of take on the sort of landlords here, the individual landlords, and rather release properties. So let's see how that impacts property prices. Other changes that sort of affect or were announced at budget day, not a lot of people picked up on this, but there was a sort of a charity tax compliance consultation going back from sort of 18 months, 2 years ago now, about charities not being fully compliant or potential anti-abuse on direct tax side of things. And we replied to that consultation, and most of it was to help improve charities to make sure that they were assessing and completing self-assessment tax returns, taking those seriously rather than just either throwing them in the bin when they're getting a notice, a bit like the Reader's Digest, or just completing nil boxes on the returns, which is tempting because often the outcome is nil, but you do need to take these tax returns seriously. HMRC are looking at them. So what's the consequences with the consultation and what they're looking to introduce in legislation that hasn't come out yet is the management of charities. There is a current requirement for fit and proper persons, seems obvious sometimes, but fit and proper persons to manage charities and lead charities. It's really the people, trustees and managers that have an impact on either direction of the charity or housing association or actually control over funds, making sure they're fit and proper persons. And in the past, that's meant they don't get involved with any tax schemes, tax abuse in any way, but also it's moving further on to ensure that you're not a persistent offender in filing late returns. So that's, or incomplete returns. So it's really important to take tax returns seriously going forward, and making sure that the people responsible file those on time. The other area they're looking at is tainted donations. So this is where you get a substantial sponsor or donor, and if there's any financial benefit they get in return. These have been, the barrier's been sort of lowered on this because it used to be a sort of motive test on whether there's a motive to get a financial advantage from the charity or housing association in this sector. It's now moving to an outcome test. That's a bit harder, here is that it's going to be very difficult to prove that let's say if a donor or sponsor who's involved with you doesn't get some sort of indirect, even financial benefit, even if that's not the main motive going forward. So one to watch for. We're interested to see the legislation on that when it comes out. The other area that they've said they're going to look at is approved charitable investments, or otherwise known as qualifying charitable investments. There are 12 criteria of different qualifying investments. Some can be land, property, or even investment in subsidiary companies, often in the structure of a housing association. There's going to be a bit of focus on investing in those where it's capital introduced, etc., and making sure, and one of the key criteria which they're introducing is that none of this is for the motive of tax avoidance in any way. That wasn't there before. That was only there on one of the 12 investments, generally things like debt, but now that's going to go across the board. And often, dare I say, is we set up tax efficient structures for charities involving LLPs, involving trading subsidiaries of housing associations, etc. Now, by being tax efficient, could that be deemed to be basically for the purposes of avoiding tax? I'd like to think no, but let's see how that develops on. So watch this space. Next slide, please. So the other thing I mentioned here, again, it's something that wouldn't directly affect you as housing associations, is the LLP limited liability partnership rules that are due to change from last month. I think we're waiting for the final rules and legislation on that, as I understand, but it's affecting capital gains when you liquidate an LLP. Now, it's quite common to have projects run with other partners involved through LLPs in the housing associations. Now, as charities involved in that, or using your trading subsidiaries, you can often mitigate or cover any potential taxable gain. But if you're liquidating an LLP, your partners may not be able to under these new rules. So that's one to watch, because it might start changing the structure. You might start seeing other things being looked at as far as structures are concerned when you're doing a development with another party. Can move to the next slide, please. So just lastly, I was going to touch on this, and John, feel free to butt in on this, because I know you've been heavily involved with the sort of look at feed-in tariffs and the taxation when your recent time at the Fed. But it was sort of many years ago, some may remember that when you got feed-in tariffs from solar panels, etc., they were sort of, there was sort of concern as to how that was treated. And I think an approach was made to HMRC. We often and originally took that as being just something that subsidised the cost of your light and heat. But sometimes it can be substantial. But HMRC took the view on this, that feed-in tariffs and the sort of smart export guarantee income is miscellaneous income. And there's no specific exemption for whether you're a charity or housing association for that. You can get small scale trading exemption if you're lucky, you haven't used it, of £80,000. But if it's beyond that, or you have other income that goes beyond that takes you over, then you could be liable to a tax charge. Now, in the past, and this is where some of the concern and discussion has happened, that from April last year, before April last year, you could actually deduct some of your sort of finance interest costs against that. So most people were covered. But going forward from April 2023, that's no longer the case. As I said, if others might want to comment on that as being part of a working party to talk as to how we treat this. But I think that was probably one of the key things that I was going to mention. And I think, I don't know, John, if we stop for questions now on the direct tax side, or any input, or should we move on to VAT and then stop at the end? Might be worth stopping at the end.
Yeah, I think questions at the end. Let's do that.
Okay. Well, I'll hand over to Socrates then to talk about the more interesting tax that a lot of people get excited about, VAT. Soc, over to you.
Okay, thanks, Luke. Well, the second more interesting tax, but from a housing association perspective, there was there wasn't anything mentioned in the budget. The budget likes to focus solely on VAT and private school fees, which has kept me busy for the last couple of months. But there are some areas where there are a couple of points to be aware of in the sector, and I just briefly want to touch on those if I can. So next slide, please. So one of the areas that's currently up for debate and is causing a bit of confusion is energy-saving materials. At the moment, the installation of energy-saving materials in residential accommodation and buildings, which are used either for housing or for a relevant charitable purpose, can be zero rated. And we've got that zero rating until March 27 at the moment. Ordinarily, it should be at the reduced rate of 5%, but there is temporary legislation that zero rates. Now, if you want to get the zero rating, there's three things that you need to be considering. First of all, the nature of the materials, what the property is used for, and whether the supplies services of installing the materials. And that's the important phrase, really, because the zero rating applies to the installation of materials. The materials themselves can only be zero rated if they're part of the services of installing them. If you buy the materials on their own, without any installation services, they're subject to the normal VAT rules and are normally standard rated. Next slide, please. Now, I'm not going to go through this whole list. What I've done there is I've referenced the VAT notice that outlines the areas where you can get zero rating. And if you look at each of those categories and cross-reference to revenues VAT notice, there's definitions of what they think qualifies under each of those categories. As you can see, it's quite a long category, and over the years, it's been expanding. Anyone who thinks they may be eligible, I think your starting point would be to look at what revenues guidance says and whether you fit with any of those definitions. There are always borderline cases, and in those instances, you might want to approach revenue if you can get hold of them to try and get some guidance. But the notice itself does give you quite a good definition of each of those categories. As I say, I'm not going to go through all of those categories today. Next slide, please. Now, the one thing to note is that unlike most reliefs for building work, the legislation itself has got no provision for the apportionment of a single supply. What do I mean by that? Well, if you've got some building work going on in a property and you're refurbishing, changing roofs, knocking down walls, and as part of that development and project, you're also installing energy-saving materials. Whereas in most cases, you can apportion between the standard rated works and the zero rated works, revenue are taking the view that you can't apportion. Okay, where you've got works that are incidental to the installation of materials, the whole supply will be subject to the zero rate. However, if the installation is actually incidental to a capital project and other works that are being taken, if those works are standard rated, then the installation of the energy saving materials are also standard rated. Now that obviously only applies if you've got a single contractor, and Revenue do comment about this in their notice, but this apportionment or lack of apportionment is a major problem. And the only simple way around it is to end up having two contracts, one contractor being responsible for the installation of the energy saving material and therefore can benefit from the zero rating, and a separate contractor who'll be responsible for the capital works or the refurbishment works. If you don't have two separate contractors, at the moment, Revenue's position is the whole lot is likely to be standard rated if the project works themselves are standard rated. So there's still representation going on in the background here between the profession and Revenue to see if we can reach some middle ground, but at the moment, Revenue are digging their heels in. So that's one to be careful of. Next slide, please. Another area there's lots of uncertainty and a bit of debate is the area of cladding. Obviously, following Grenfell, there's lots of remedial work that needs to be undertaken in order to put things right. Revenue's position is that 9 times out of 10, that work will be standard rated because unlike the construction of the original building, this isn't the construction of a brand new dwelling. Revenue take this as being repair work and therefore should be standard rated. The one thing that I would ask is whether or not actually there's an argument there to say that the installation of this cladding is actually zero rated under the energy saving material. Is it insulation, for example? And again, that's a point that you might want to make to Revenue if you're caught by this. If you are charged VAT, the next question, of course, is can we recover the VAT? And the usual starting point for being able to reclaim VAT is there a direct link with a taxable supply? And the fundamental problem we've got here is if you're replacing the cladding on a residential home or a residential building, a hostel, the only income that you're generating from there's likely to be exempt rental income. And so therefore, direct attribution, you're incurring costs that relates to an exempt supply, you can't recover the VAT. Again, lots of representation has been made to HMRC regarding this point, and they seem to be slowly drifting towards taking a view that if there's a reputational risk to the contractor, so let's say you're one of the big developers, if you're a Taylor Wimpey, for example, and there's a reputational risk there for you, if you undertake the remediation work, then Revenue are willing to treat that as an overhead cost and therefore partly recoverable subject to your normal VAT recovery rate. But that's not a very satisfactory position. You know, if you're a one-off developer and you're not ongoing, you've had a one-off development and you're now having to go and put it right. At the moment, Revenue's view is you won't be able to recover that VAT. Now, Revenue did propose that they're going to issue some updated guidance after the general election. We're still waiting. We haven't seen anything published yet. So there's no real clarity on this particular point that we can all look to. I think it's always a question of making individual representation, unfortunately, which isn't very satisfactory, but that's where we are. Next slide, please. Another area that I'm seeing some questions on is the provision of management services. So a classic example, the housing association is a landlord, receives exempt rental income. Within the building, there's a supporting people contract that a charity is servicing. So it's providing supporting people services to the tenants. And because of that, the housing association says, okay, charity, you collect the rent on our behalf. So it's subcontracting the management service in order for the charity to collect those rents. In the past, Revenue have always accepted that those management services are exempt on the basis that they're ancillary to the provision of the welfare services, because supporting people contracts are treated as exempt welfare. Now, we're aware that some VAT officers are actually challenging that position. Okay, they're arguing that the management service is a standalone service and is standard rated. This contradicts long-standing guidance that was issued by Citra many, many years ago. I've not seen anything that overrides it, but I've not seen anything confirming it's still applicable. So again, I think we've got an area here where potentially there may be questions asked, and it could be a point where individual officers are picking these things up If you're picked up by this, and it's worth challenging the position. I don't know if there's anything general going on via the Federation that we could possibly look at. Maybe John can comment on this further, but this is another area just to be wary of. Next slide, please. Then I've got a couple of slides here, just some general things that apply to all housing associations, and I'm sure you're aware of them, but just in case you're not, design and build structure. The whole purpose of a design and build structure is to set up a situation where the professional fees take on the VAT liability of the construction services. And why do I say that? Well, ordinarily, you're constructing new dwellings, the construction services are zero rated, whereas professional fees are always standard rated. If the standard rated professional fees relate to short-term lets, i.e. generating exempt income, the VAT won't be recoverable. So the best way of mitigating that VAT is not to be charged it in the first place. And as I say, you can do that by setting up what's called a design and build structure. In my experience, most housing associations are organised in this way, but if there are any out there that haven't, it's certainly something worth considering. I've outlined there the bullet points that you need to think about for setting up one of these structures, the contractual terms between the parties. Got to put the design and build company in a situation where it's got the wherewithal to be making the supplies, i.e. does it have staff, does it have premises, and it needs to have a small markup on the provision of its management services or the design and build services up to the housing association. Critically, the design and build company is normally the one that enters into contracts with the third-party contractors, and it's the one that's raising the invoices to the housing association. But if anyone needs more detailed guidance about this one, please feel free to contact me separately. It's one of these that you just need to make sure you've dotted the I's and crossed the T's when you're implementing it. And I'm sure there's direct tax implications with this as well, which no doubt Luke can touch on. Okay, next slide, please. And then finally, partial exemption and the VAT recovery method. Again, most housing associations will be what's called partly exempt, i.e. they can't reclaim all the VAT on their overhead costs. And the default position when you're operating partial exemption calculations is that you use a method based on turnover, which is referred to as the standard method. Now, there is a framework agreement between the housing sector and revenue that allows the use of sectorized calculations. And 9 times out of 10, a sectorized calculation is going to give you a much better recovery than a turnover-based method. That's literally because of the level of exempt rental income that you're receiving. So again, if there's any housing associations out there that aren't using a special method, that's something that you need to look at. In order to get that special method, you do need the approval of revenue. So although there is a framework agreement between the sector and revenue, you still need to formally apply for a special method if you don't want to be stuck with the standard turnover method. How often should you review it? Well, as part of your partial exemption calculations, you are supposed to do an annual adjustment. I would say that that is always a good time to consider whether whatever method you're using is still giving you a fair and reasonable result in terms of VAT recovery. Okay, next slide, and I think that's probably all of my slides. Thank you, everybody. I'll pass that back over to John. I don't know whether we've had any questions flagging up as we're speaking there, but yeah, any questions, now's the time to ask them.
Yeah, no, thanks, Soc. So as Soc says, yeah, if anybody does have any questions, feel free to jump in and ask a question. But while people are thinking about that, Luke, I'll just ask you a quick question, if it's all right. Just so in terms of the kind of the costs of all these changes from the budget, national insurance, living wage, all that stuff, and the other measures, what's the impact on the construction costs, and will that just end up housing association bearing the cost of all this?
Well, that's the big concern, and the thing is that until each individual organisation does their calculations, I think, as I said earlier, we looked at it sort of from the sort of social housing sector type, side, but it affects the whole construction industry very much so, and I think, given sort of labour costs, etc., I think that's going to be passed on to you as say housing associations as the funder of these, and I think that's the sad reality is these costs will have to be passed on. But we'll wait and see what's going to happen. there's all sorts of talk. I've had lots of clients in the not-for-profit sector saying, sadly, not going to be able to increase people's salaries, etc., going forward. Even the cost of living may rise. That's going to probably mean a loss of staff turnover. And that it's going to be interesting to see how it happens. I hope I'm wrong, and I hope it helps to feed some of the gap that the government are looking to fill. But I think it is going to be a cost, John, that is going to come back on the sector, unfortunately.
Yeah. Okay. Thanks for that, Luke. So I'll just ask you a question as well while we're waiting for others to think of them. Sort of, I suppose, in terms of inspections by HMRC, it's sort of, I guess the question is what triggers them and how often are they happening, really? At the moment?
It's an interesting point. One thing that was announced, I don't know if it's part of the budget or just before the budget, is Revenue actually taking on 5,000 new staff. And certainly in the charity sector generally, we're beginning to see increased VAT inspections. It's been a very, very long time since we've seen officers coming out, but certainly we've seen increased activity. And I think the penny's finally dropped with government that actually, if you increase the number of VAT officers you've got out there, and I have to put my hands up and say I did work for the dark side a long, long time ago, you send a VAT officer out who understands what he's doing, and 9 times out of 10 he's going to generate some money. So the penny's finally dropped that if you get VAT officers on the ground and they're going out and doing their jobs properly, actually they're going to more than pay for themselves. I often joked with revenue policy that if they were willing to give me a contract to go out and give me a commission on whatever assessments I'd raise, I'd go back and join them. And I think that's the penny's dropped to them. So there is increased activity. One thing that does always trigger a VAT inspection is if you put a VAT return in asking for a large repayment. 9 times out of 10, Revenue are going to ask questions before they repay. But going forward, it's interesting that Revenue also recently issued some updated compliance guidance and what they expect from taxpayers, and that seems to dovetail with their recruitment driving the sector. So I do think going forward, there will be increased activity and inquiry from Revenue. So it's quite important that we do check our VAT accounting processes. We've got documents to support how we file our VAT returns, and we get some comfort that they're accurate because there will be increased activity.
Okay, thanks a lot for that, Soc. I think yeah, it's going to be certainly challenging, all of that. One of the things that certainly when I was at the NHF, and it's still a concern I know of many housing associations, and something that's been raised to me since leaving the Fed by many of our clients, is the impact of the economic crime levy. I thought I'd just comment on that because it was I've obviously covered areas of the budget and the kind of the wider policy piece, but obviously I was the finance policy leader at the NHF and that fell under my brief when I was at the Fed. Firstly, just a bit of a sort of history and a background to the ECL, the economic crime levy. That really came in a couple of years ago or a year and a half ago. That impacts all housing associations where they carry out certain activities. Those fall under particularly shared ownership, the resale of shared ownership units, but also in terms of debt advice and any kind of credit broking arrangements as well. Largely, when I was at the NHF, that fell, that impacted housing associations carrying out the resale of shared ownership. I think the proportionality of this is really a problem for housing associations. For instance, there was a housing association that carried out, and this is quite common, say 2 or 3 shared ownership resales a year in their organisation, and would they fall under the levy because of the extent to which they are acting as an estate agent and therefore fall under the HMRC regulations and so forth. And so they then have to pay 36 grand a year because of that, because they fall under the levy. And the fact that next year the upper limit of the levy, and some housing associations will pay this amount, is moving from 250,000 to 500,000 next year. So there's a lot of concern. There was a lot of concern when I was at the NHF about the levy. There is still concern out there. There is the Fed has put it in their budget submission for this budget. So it's certainly, I think, watch this space and see what the Federation, what can move on this, because that is still a concern and leading to increased costs. And really, housing associations for sure pulling out of some of those activities which are only there for the provision of their tenants and their shared owners. And it's that proportionate impact, that disproportionate impact on housing associations that is of real concern to those housing associations. So I think now we've done a few questions. Has anybody else got any questions kind of from the attendees? Okay.
Stunned everyone into silence, John.
We have done the morning signs on it. There's also the chat option, but I think maybe we'll call it to a close, maybe just a little bit ahead of time, but I think that's all right. Give everybody 5 minutes back. Anyway, just to say again, we'll be sending you the slides and the recording of this seminar. Thank you very much for attending. I hope you found it useful. I hope there's some takeaways for you, and we'll see you all again soon. So thank you very much again for attending, and see you shortly.
Thanks, everyone.
Thank you, everyone.